What's up, guys? Kezon McNeill, right back at you with another episode. Today, we are talking about retirement. Yes, retirement. Most people go through put money into some type of 403B or 401k, and at age 65, when they retire, they start taking some income. Or if you're in a position where you don't need to take retirement income right away, people usually wait till, well, it was age 70, now it's age 70 and 72. It was 70 and a half, but now it's 72 before you are hit with taxes or fees in that matter if you don't take the required R&D, right? But what I want to talk to you guys today about is retirement, like really retirement. Most of you, or most Americans, what we do is we pay into a 401k at our jobs. And we start working at 18, or some of us after college at 22, 23, and we just sign up for a 401k, and that's what we do. But if you were to use like simple logic, right, and look at the money you're spending in your 401k, and this is supposed to be in the market, it's a retirement. It's supposed to be a vehicle that's going to help you have income when you retire. So anytime you're in a position where you're getting income when you retire, you don't want to have your money having it at a lot of risk. You don't want to be very risky. Retirement means retire out of service. So you want to make sure that if you're out of service and you're not earning any more money, that you can count on that money that's coming in, right? But while you're building up that kitty in the retirement vehicle, for most of you, it's a 401k, you're going to deal with the market, ups and downs. Period. There are ups and downs in the market. You can't predict it. It's going to happen. You live long enough, and most of you work 40 years after then you retire. You've probably gone through 4 or 5 crashes, maybe even more than that. So the money, it's very fluid. It's not guaranteed. It's a risk. It's very risky. The market's risky, right? So we're going to talk about retirement here. I want to put something on your minds, right? And just to give you something to think about as it relates to, do you want all your money tied up in a 401k? And I'm hoping the answer is no after we finish this conversation. So in the retirement world, things that I refer to my clients and that I really highly recommend, what I always try to accomplish in helping them secure some type of retirement vehicle is I always want to make sure that we can eliminate taxes whenever we can, right? We want to minimize stock and market risk. We want to minimize those risks, all right? And in all cases, we want tax-free income for life. Now, that could be $1,000 a month. It could be $800 a month. It could be $20,000 a month, all based upon how you set up your plan and what you were able to put into your plan, right? So those are the things that we really, really want to accomplish. Now, any type of retirement vehicle, what you want to think about is this. You ought to have things in place that protect your money. It guards your money from being garnished. It guards it from being taxed heavily for the future. And you always want to pay taxes now, not later. Why is this? You want to pay the lowest rate always in taxes. So the reason why you want to pay now is because we can all agree that in the next, let's say, if you have 15 years left to work, we can all agree that the tax rate is going to probably be higher in 15 years than it is today. So that's simple logic, right? So we want to pay the taxes at the lowest rate right now. So what I mean is, for those of you who have 401ks, you're not paying taxes on that money right now. It's deferred. Deferred, meaning, when you retire, we'll tax you later. So why would you want to live in the unknown? You don't know what the tax rate's going to be. But I know what your advisor's telling you. Oh, you're going to be living on less income by then, so your tax rate's going to be lower than it is now. Don't hold on to that. But let's say your income is lower, right? And now you're taking these required minimum distributions on your 401k. If you're living on a lower income, but they're still taxing you at a higher tax rate, no, it may not be what you were paying when you were working in your earning years because you were making more money, but it's still going to be significant, and it's going to hit your income, your fixed income for that matter. So you don't want to risk that. You don't want to risk that. And let's say you don't even need the money by the time you turn 72. Let's just say you can let the money sit. No, the government is saying, no, you got to take a required minimum distribution. They call them R&Ds. You got to take one right now. But if you don't want to, we'll just tax you 50%. So they're going to make you take your money. So I just don't believe a 401k should be the only vehicle. I don't think it's a vehicle, period. That's just my opinion. But I think you should do other things to supplement that. Because when you retire, you're going to have probably two sources of income: your 401k and Social Security, right? Those baby boomers, they were very fortunate. They have their pension, 401k, and Social Security in most cases, right? Because if you do some due diligence on a 401k, it was never meant to be the total solution to retirement. It was just never meant to be that. It was meant to be part of a three-headed monster, meaning you were going to have your Social Security, you were going to have your pension, and then you're going to have a 401k. And so with those three income sources, that could really help individuals, if not have the same salary when they retire, close to it, within 15% of that number. But what happened was these companies got smart. They said, why are we spending all this money in a pension when we can just have a company set up a 401k and we can contribute to the 401k or match or whatever it is they tell you, but they're still coming out cheaper. You know why? Because they write that off, And now they have you believing a 401k is the retirement solution. But it was never meant to be a total retirement solution. It was meant to be part of a three-headed monster. As I mentioned, your pension, your 401k, and Social Security, period. But that got lost in the sauce when these companies started saying that, wow, we can save some money here. Instead of contributing to a pension plan, we'll just do the 401k. And that's kind of how you started to see the pensions kind of start to die out, all right? So there are two ways you can get tax-free income at retirement. Two ways, two sources. One is a Roth IRA, and the other would be life insurance. All right. Now, they both are excellent, but let's talk about the Roth IRA. Okay. So with the Roth IRA, you're going to get tax-free income. But what I don't like about the Roth IRA, it's close, but what I don't like about it is you're still limited with the money you can contribute in. You're going to be capped out. All right. So for someone who's earning $600,000-$700,000 a year, or $200,000 a year for that matter, they can still only put in a limited amount of funds into the IRA. Now, life insurance, which is my number one choice, you're not limited. If it's designed properly, a cash value life insurance policy. And I'm gonna go a step further, index life insurance. So index IUL, okay? So it's called index universal life. All right. I'm not talking about whole life, although I think whole life is a great product, but I just don't think over a period of time, past 15, 20, 30 years, that a whole life performs as well as an IUL when we talk about retirement. Yes, it can be used, but the difference is with a whole life, for example, you could be, let's say you're getting $50,000 a year with a whole life. But then that same policy designed the same exact way, put them beside each other, apples or oranges, right? Apples to apples. That IUL would probably outperform that. Instead of $50,000, you could be looking at $80,000 a year, right? So those are the glaring differences, all right? If we're talking about retirement, I think whole life is a great product. I use it. We have it in our family banking strategy as well. It's IUL. So, but when we're talking about retirement, cash value life insurance, you're not capped with how much you can contribute to this product. So I want you guys to really, really start taking a look at your retirement structure. Like, what do you have going on? Where are you at risk? Are you buying real estate, or are those rentals going to help you with retirement income? Are you just really depending on your 401k? Or do you have some other, are you a business owner? Do you plan on selling the business when you retire? Regardless of all of the above, you still should have a properly structured IUL product in place. And I'm talking about universal, index universal life insurance, or whole life, just depending on the scenario, okay? This is why, because when you do retire, right, now you're getting 401k money. That's a part of your retirement. You're gonna be drawing Social Security once you hit the proper age, right? And then you also have this retirement income coming in. Now, the other two vehicles I mentioned, Social Security and 401k, those are taxed. Life insurance is tax-free. So if you're getting $40,000 a year in life insurance, it's really like getting $65,000 a year because it's not taxed. And we know that inflation is continuing to rise 3.5% a year like clockwork. So what the dollar's worth today won't be worth tomorrow. You know what I'm saying? So that's going to come up huge, right? So what I want you guys to really think about starting an IUL policy today. Because another great perk, yeah, people always ask, okay, why am I going to get insurance? Because what's in it for me? You know, people still have this mindset that insurance is only, its only use is when someone dies, someone gets a check. No. There are many wealthy families that their foundation was built on life insurance. And not just because some rich grandfather died, no, because they were using it as a vehicle for income today. And that's what I want you guys to think about. If you properly structure, you got to deal with an agent who knows what he's doing, i.e. myself, right? Or someone on my team, right? But when you talk to an agent, you know, if you have a friend who's an agent, a family member, and you're having a conversation with them about cash value life insurance, in most cases, you know, they're going to structure the policy based on how they were taught. They don't know how to properly structure and design a universal product for you. They don't know how to do it. They've never been taught. You know, so you could be paying $400 per month, you know, for a product where you know, you're not going to ever build any cash value or any significant cash value. Or you could be paying $400 per month with a lower death benefit and be creating thousands of dollars every year that's compounding. And guess what? It's never at risk. Like we talked about with retirement, you want to minimize your risk. You want to pay no taxes. And with the properly structured product that we have, we can accomplish that. If you have the product, everything else takes care of itself. The right product will put you in a position where, like, I'm 45 years old right now, and I've had my product since 2008. I now have 7 policies between my family, my immediate family here, or my kids and my wife. And we use those policies as a vehicle to get out of debt. And we also use it as a vehicle I use it as a vehicle to start one of my businesses. So I became the bank. So these insurance policies provide way more benefits than just dying. They provide living benefits as well. So think about that, guys. I hope you guys got something out of this episode. By the way, there's a like button down there. Please crush that, smash that like button for me. It really helps out with the YouTube algorithm. And then also, please subscribe to the channel. And if you like what you saw, furthermore, please share this with someone else who could possibly benefit from hearing this information. As always, guys, run your race, and I'll see you on the next episode.